I'd like to welcome my guest, Jerome Schneider, short-term strategist at Pimco. Let's get right into the main topic of the day as we get ready to see the president sign Phase 1. What are your thoughts on Phase 1?
Ultimately, we've had a long road to get to this point. A lot of the market is obviously priced in a lot of the positive inertia to this. And to this point, we have to really see how it comes into growth patterns, how industrial production, how the factors of getting this $200 billion of actual purchases comes back into the economy. And that's really going to be a focal point for investor sentiments, not just for the course of the next quarter or so, but really over the next 2 years as it comes in back, filters back into the economy in the form of CapEx and other things. So growth, focusing on growth, moving above 2%.
Bringing some money back in for investment. But I'm going to go with the simple answer. Larry Kudlow, I agree with you. To me, I think the fact that we were able to put them in the penalty box for close to 2 years, like that aggressive hockey player that commits a lot of fouls, just doing that takes a lot of nerve. I don't know any other politician that could have done it. Let's get to the repo market. That's the real story for 2020. The Fed's trying to come up with ideas because they know what they're doing is not a fix. It is just some salve they put on it to get the market through, to satisfy the hedge funds' addicted need for overnight liquidity. Where is this going to go?
Well, ultimately, we have to look at the liquidity of the market. We saw it atrophy back in September. Now they've adjusted the symptoms of the market, which is really additional liquidity. They've added $350 billion of additional liquidity, primarily through the purchase of term operations.
Now they're talking about all these exotic, sponsored repos.
But ultimately, you have to look at that the liquidity can be transient. And this is a factor that ultimately investors are going to have to focus on over the next year. It can be good, and then it can go away.
Yeah, but it's only transient. Like a hungry village would look at food as transient. We have these big leveraged institutions that are devouring it, and the source of liquidity is distorted due to the aftermath rules of the credit crisis.
Undoubtedly, the structure of the market has to be addressed, and the Fed's trying to do this. It's ultimately going to be in the form of a regulation that will happen over the course of the next few years. But more importantly, as you look at what the market's doing today, the Fed's purchases of T-bills is really going against the saver. It's pushing down yields as they purchase 60 billions of T-bills every month. And as a result, we have to really think about what that does to savers and in terms of lowering the rate. Obviously, funding costs are lower. That helps to create a credit appetite and a risk appetite. And so ultimately, the big picture is optimism prevails in this marketplace, and uncertainty is everywhere. And so while we simply have this optimism in the market because risk assets are continuing to grow, we have to be a little bit more cautious in terms of the risk-taking that we're doing because of the changing liquidity conditions and, frankly, where we are in the growth cycle.
And nothing sums up what you're saying more, Jerome, than to think about the southern economies of Europe and negative rates and the fact that the Italians had an auction and they were flying sovereigns off the shelf like there was no tomorrow. Why?
Well, ultimately, you have to look at the risk-taking that's being done.
Because we've put a green light on buying pretty much anything because everything is being bought by or chased by more than one investor.
Coming back to full circle, you have to think about what that means for investors. It's a high-conviction market, and the only reason you're going to take risk is that you believe in that conviction. Otherwise, it might just be a time to earn a little bit of carry and be more defensive with a diversified portfolio, and that's exactly how we're thinking about it.